Hey everybody, Eric Hale again. I am joined by my friend Dave Nadig. Let's get it straight, by the way. It is not Nadig. It is Nadig.
It's either one, as long as I'm here.
As long as you're here. Okay. David, you are my favorite financial futurist.
Because you know so many.
Well, you're the only one. What's a financial futurist?
Well, it's a title I invented, obviously. What I am really, what I tell my kids is I get paid to write about money on the internet. That's
Okay.
kind of been my job for a very long time. My lens that I look through is trying to understand how what we do with money impacts the course of what we're doing. Like it is the conduit of power in our entire world. And I think we all know that. And so thinking about that as the lens, how does money and influence move through markets is, I think, a useful lens for investors to understand what's going on in markets and for people to help navigate the real world.
So we're here at Camp Kotok 2025, and one of the reasons why I love coming here is just having fascinating discussions. And that's the reason we come here, right? Is that we have great discussions with people who maybe have different perspectives and expertise. And you and I had a conversation this morning, and I just wanted to remind you, or let's review some of what we talked about. First, so your specialty is an ETF. So what was your background? Just real quick, a little bit of resume on your ETF experience.
So my first real ETF experience was back at what was called Wells Fargo Nico in 1993. That's the entity that became Barclays Global Investors and is now part of BlackRock. And so I was part of the team that was working on what became iShares. Eventually, they were called World Equity Benchmark Shares. Those launched in '96, I believe. So I was working on part of that team, mostly delivering coffee. I was a small child at the time. And then over the rest of my career, I've either been using ETFs for a while. I was running active money during the dot-com boom, or been analyzing ETFs and looking at the market structure implications as they've gotten bigger and bigger and bigger. In the beginning, they were crazy little trading vehicles, and now, boy, they feel like the whole market.
They do. So I just had a conversation with our friend Barry, and his book, of course, the title here,
How Not to
How
Invest.
Not to Invest. And you and I had some conversations this morning a little bit about just some interesting, I think I use the term silly things that are going on into the ETF space.
How not to ETF.
Am I going to put you on the spot here if we have this conversation?
No, let's go.
Okay. So I run into retail traders. Right? So we focus mostly on retail traders.
Right.
We try to help them understand markets. And
Huge part of the ETF market, right?
Isn't it? One of the interesting things that we see people doing is leveraged ETFs.
Mhm.
And I shared an anecdote of a story with a woman who was trading a leveraged ETF and it moved 14%. She expected it to move 6% because it's triple leveraged. And we found out that it was rebalanced. Explain what rebalancing means on these leveraged products.
So when you think about how you use leverage, and not to get too technical here, but when you think about leverage, you start with, say, 100% of something, and now you want exposure to 200% of something.
Right.
Well, somehow you have to get that. So you have to lever up to get to that 200%. Now, if you take that 200% exposure into the market tomorrow and it goes up 10%, okay, well, your 200's now what? Okay, well, your 200 goes to 220.
Right.
Problem is, if your promise is every day we're going to do 2x your money, you actually now need to buy more because now you need 2x of the 110 that you started with.
That makes perfect
basis
sense.
back up. So the problem is the leverage funds are continuously buying into their up market days, and on the down days they have to be net sellers because that's just how daily rebalancing that promise of 200% or minus 200% has to be balanced. There's just a trade that automatically has to be made that's pro-cyclical. So that's fine if you're using this as a trading vehicle during the day, right? If you buy it at 10 o'clock because you've got a strong opinion about a stock or an index going a certain way, great. I have no issue with that whatsoever. As soon as you hold it overnight, now all of a sudden you're buying into that rebalance, which means that there's going to be a pattern of returns that's not what you expect. And usually it turns out to be volatility drag, meaning, wait, I thought I was getting 2x, but I held it for 3 weeks. I kind of got like 1.8. And that's often what happens is there's a drag on your expected performance. It's not doing anything wrong. It's just how the fund has to trade to every day show up in the morning and say, we're going to do 200% today.
So I know you're an AI fan. So tell it to me like I'm an eighth grader. So what does it mean to me as a retail trader to an equity that I'm trading that I hold over multiple days? What can happen to the price?
Here's the easiest way to think about it. if the underlying security, like a single stock or the S&P 500, if that has a volatile path, meaning it's up 3%, down 3%, up 3%, down 3%, there's going to be a performance detriment to what you think you should get. Conversely, if what you have is a long, slow trending market, up half, up half, up half, up half, you'll actually do better than you think you're going to be doing because you're going to be buying into that slow volatility upside. You can use that, like you can harvest some of that away if you really like get clever about it. But for the most part, it means if you hold it for more than one day, you should be expecting a pattern of returns based on volatility, not the underlying itself.
Right. So you may not get, so people think they're going to be getting 200x in over a year. You see whatever it was you moved, or 200%, and you may not make that at all. The price can change overnight on these assets.
And in the kind of high volatility assets that I know retail is really interested in right now, the problem is high volatility assets, you're going to notice it way faster than looking at the end of the year. Right. If you hold these things 2 or 3 weeks, you'll have a noticeable deviation from your sort of naive expectation that it said 2x on the label.
Well, I was talking to the company here that just Tukrian, who just introduced XXRP, and they've had incredible assets in a very short period of time, and there's no redemptions. Everybody is holding it for a long period of time, and he says they're not supposed to be doing that. It's made for intraday, so you can't blame it on the ETF. The providers, they make it pretty clear if you read the prospectus, right? Who reads the prospectus? Another interesting thing that we talked about is these YieldMax things, which are getting a ton of attention. What do retail traders need to know about that?
The biggest issue with them is, I mean, fundamentally what you're doing is selling volatility and collecting premium, right? That's a totally legitimate strategy. No issues there. The YieldMax products are doing that on steroids, and they're distributing that premium income on a continuous basis. Now, it's not a straight equity premium income strategy. It's a little more complex, but it's designed to create distributable income on a very regular basis. I think they're all monthly. Don't hold me to that. That shows up in your bank account. So you put in $500 or you put in $1,000 and they have a 14% monthly distribution. Right. Well, okay, like $140 showed up in my bank account. It feels like income. Now it's a distribution, so we should all know that means the NAV came down, right? No magic money was made here. But because you are generating real income from selling these options, right, in these volatile stocks, there is legitimate income, and then there's sort of this guaranteed distribution income. The problem is almost all of these are underperforming just buying the thing you thought was great. Right. So if you wanted exposure to MicroStrategy, you're generally better off just buying MicroStrategy than going on this very aggressive, nearly getting full equity exposure strategy, which does generate a lot of income. There's a lot of checks going to show up in that bank account or that brokerage account. But boy, the tax hit at the end is going to be crazy. And you're not going to do as well as just owning the thing that you were targeting, MicroStrategy or Microsoft or anything in between.
We'll clarify, we talked this morning about return of
capital.
Return of capital instead of return on capital.
A very big difference.
It's a big difference, which means if you give me $1, I give you back 14 cents. Now what you have is worth 86 cents, but I gave you back 14.
Right. Your base is lower, and you just get handed back your money.
And you get to pay taxes on it.
Well, here's the thing. Here's why return of capital can be a good thing.
Okay.
There are legitimate weird parts of the tax code that generate returns that are classified as return of capital. MLPs is a big one. Like that whole category, lots of return of capital. When you actually get a return of capital distribution, no, you don't pay any distribution. Okay. You don't pay any taxes on it because you just got your money back. It's literally like they rejected your investment. Okay. They handed it back to you. It's not even considered a transaction for tax purposes. It does lower your basis. So eventually you run out of basis, and another return of capital distribution is just going to be current income. The problem with what's gone on with the YieldMax products is the way the option strategy works is how it will be classified, whether all of that income you got magically all year long is going to be return of capital or just straight up current income. You don't know until you get the 1099. And in the case of the big one at YieldMax, which was MicroStrategy, it changed 6 days before the 1099.
So 6 days before
everybody thought they were getting return of capital. Guess what they all got? Current income. So if you put a
1099, now they're going to pay taxes on it.
Yeah.
So tell me some other stories about ETFs that retail traders. What do you see that maybe retail traders should be aware of?
Yeah, so the leverage ones we hit, the hyper income ones is another one. I'm a little wary of things like the zero day to expiration options products. I think those are a little bit untrusted territory. I have some concerns about zero day to expiration options and how they're going to impact things like NAV calculations. So that's a whole nother can of worms. Private markets is the other big one, right? Everybody's talking about private credit or private equity in an ETF wrap.
What was this ETF that you said? This new is it an ETN with the SPAC thing?
I'm not even sure which one you're talking about. I apologize.
There's a new filing.
Oh, well, so back on the hot sauce
This
side,
is the silly.
this is on the silly side of things.
Okay.
Back on the hot sauce side, we did see the very first blank X blank ticker filing, meaning we're going to launch a fund and it's going to be 2 times something else, and we'll tell you later. Now, the reasoning for this was we had, I can't remember what it was. We had a couple of big IPOs this week.
Okay.
One of them got a late ticker assignment. So they literally had to file a product that said, we have no idea what the security is that we're going to lever up, but we're going to do it, which is kind of a first.
But nobody's buying it yet. Right.
It's not trading yet.
Okay, well, that's good. But people probably would buy it.
Right. Although, that pattern, like we're getting products to market faster and faster and faster, and the SEC is kind of just having to let more and more stuff go through. So it really is a buyer beware market out there.
Well, I appreciate you taking time out before dinner. We got lobster coming. It's going to be a great night here. Look forward to seeing you.
Yeah, let's go have dinner.
Thanks, my friend.
Cheers.